I wish I could tell you that the big banks have your best interests at heart, but I'm afraid that's just not true. Everybody wants to make more money, including banks, and sometimes that means keeping you in the dark. But in this video, I'm going to uncover some secrets banks don't want you to know. We'll look at insider tips and tricks to help you outsmart the banking system and get the best deals. But first, it's important to take a quick trip down memory lane and talk about the history of credit cards. Credit cards as we know them today started in the mid-20th century. The first universal credit card, which could be used at various stores, was introduced by Diners Club in 1950. Then, in 1958, American Express launched its own card, and the idea really took off. Banks saw the potential and began issuing their own cards. Over the years, credit cards have evolved and become a common way for people to manage their money and make purchases. But here's the thing, banks and credit card companies make a lot of money from these cards, usually at the expense of the cardholders. That's why there's a bit of secrecy around how they work and how you can use them to your advantage. Let's break it down and get into those secrets. First off, let's talk about interest rates. Credit card companies usually attract you with low introductory rates. They might offer you 0% interest for the first 6 months to a year. This sounds great, right? But what they don't tell you is that after this period, the interest rates can go way up. This is where many people get caught. They build up a balance during the 0% period, then suddenly they're hit with high interest rates on their remaining balance. The key here is to pay off your balance before the introductory period ends. If you can't do that, think about transferring your balance to another card with a low or 0% introductory rate. This way, you keep avoiding those high interest rates. Next, let's talk about minimum payments. Banks make it sound like paying the minimum is enough, but in reality, it's a trap. When you only pay the minimum, the rest of your balance starts to accumulate interest, which can add up quickly. To give you an idea, if you have a balance of $1,000 with an interest rate of 20% and you only pay the minimum of $25 each month, it could take you years to pay off that debt, and you'll end up paying a lot more than $1,000 due to interest. So always aim to pay more than the minimum. Even if it's just a little bit more, it makes a big difference in the long run. Another trick banks use is something called the grace period. This is the time between the end of your billing cycle and when your payment is due. If you pay your balance in full within this period, you don't have to pay interest on your purchases. However, if you carry a balance from month to month, you lose this grace period. This means new purchases will start building up interest immediately. So try to pay off your balance in full every month to take advantage of this grace period. Now let's talk about rewards programs. Credit card companies usually offer rewards like cashback, points, or travel miles to attract customers. While these rewards can be great, they can come with a catch. For example, some cards have annual fees that can be quite high. Before you get tempted by the rewards, make sure to calculate if they actually offset the annual fee. Also, be aware of expiration dates on points or miles. Some rewards can expire if you don't use them within a certain time frame, so keep track of your rewards and use them smartly. One more thing to watch out for is balance transfer fees. When you transfer a balance from one credit card to another, you might be charged a fee, typically around 3 to 5% of the amount transferred. This fee can eat into the savings you're hoping to get from a lower interest rate. Always calculate the total cost, including any fees, before deciding to transfer a balance. Okay, let's switch gears a bit and talk about credit utilization. This is the ratio of your credit card balance to your credit limit. Banks often don't explain how important this is. Ideally, you want to keep your credit utilization below 30%. For example, if you have a credit limit of $1,000, you should try to keep your balance below $300. High credit utilization can seriously bring your credit score down, which can make it harder to get loans or new credit cards in the future. Keeping your utilization low shows lenders that you're responsible with credit. Now let's talk about fees. Besides the interest, credit cards come with a variety of fees that can catch you off guard. Late payment fees, over-the-limit fees, and even foreign transaction fees if you use your card abroad. Always read the fine print and be aware of these fees. Some credit cards offer no foreign transaction fees, which is great if you travel a lot, and setting up automatic payments can help you avoid late fees. Another secret banks don't want you to know is that you can often negotiate your credit card terms. If you have a good payment history, you can call your credit card company and ask for a lower interest rate or a higher credit limit. It might surprise you, but they often say yes. Banks want to keep good customers, so it's worth asking. The worst they can say is no. Let's also touch on credit card protection benefits. Many credit cards offer protections like extended warranties on purchases, price protection, and travel insurance. These benefits can save you a lot of money, but banks don't always highlight them because they want you to use their paid services. Make sure to read through your card's benefits guide and take advantage of these protections. And of course, we have to talk about credit card debt. Banks profit a lot from people carrying balances month to month. They make billions in interest every year. The best way to outsmart them is to avoid carrying a balance. Pay off your credit card in full every month if you can. If you're already in debt, focus on paying it down as quickly as possible. You might want to use the debt snowball or debt avalanche methods to pay off your debt efficiently. The debt snowball method is when you pay off your smallest debts first, while the debt avalanche method focuses on paying off the debts with the highest interest rates first. Both methods have their advantages, so choose the one that works best for you. One more thing to keep in mind is that your credit score is affected by how you use your credit cards. Your credit score is a number that lenders use to decide how risky it is to lend you money. A higher score means you're seen as less risky, which can help you get loans with better terms. Using your credit cards responsibly, like paying off your balance each month and keeping your utilization low, can help improve your credit score. Finally, remember that it's important to review your credit card statements regularly. This helps you keep track of your spending and spot any errors or fraudulent charges early. If you see something that doesn't look right, contact your credit card company right away. They can help you resolve the issue and protect your account. Credit cards can be powerful tools if you use them correctly. They offer convenience, rewards, and protection. But if you're not careful, they can also lead to financial trouble. By knowing these secrets and tips, you can outsmart the banks and make your credit cards work for you, not against you. If you found this video helpful, please give it a thumbs up, comment, and subscribe to the channel for more tips on managing your finances.